If you don't know what a fair value gap is, you're literally missing institutional entries, and that's where 92.5% of traders actually fail in the market. And that's why in this video, I'm going to cover exactly what a fair value gap is, why they exist in the market, and the best times to actually trade a fair value gap. As a little bonus, I'm going to give you my A+ fair value gap strategy that I trade every single day during the New York Open at the end of the video, if you can make it. So let's get right into the video. Just before jumping to the charts, fair value gaps always happen between 1, 2, and 3 candles. Once 3 candles are formed, you always want to look for a complete gap in the candle. So for example, right over here between the wicks, we have a fair value gap. Now, if the wicks overlap, we do not count this as a fair value gap. This is not a fair value gap anymore because there is no gap. Simply, in the most simplest terms, there's no gap. So if we have the gap, then from one wick from the first candle to the third candle, we have a fair value gap. And what happens when we form a fair value gap? Price rejects and continues in the opposite direction to continue the trend. So once again, a real life example this time. We have 1, 2, 3 candles. What do we see? One wick over here, one wick over here between the first and the third candle. What happens? We mark it out as a fair value gap. What do we see? We have 1 rejection. We have 2 rejections. We have 3 rejections, and we even have 4 rejections. Now, fair value gaps can have 30 rejections as long as there is no full body close above it. It can be a wick, perfectly fine, as long as it's not a full body close. Now, you might be asking, yeah, okay, I understand what a fair value gap is now, but what is it? Well, a fair value gap is simply just liquidity left in the market. It's kind of similar to buy side liquidity. Just in this case, money in this case right over here moved in such a rapid pace. These 1 and 3 candle didn't actually have time to make a candle wick to go inside of the zone to generate all that liquidity. So in reality, we actually left money on the table, and we know the markets, they're Jewish, bro. They're not just going to leave money on the table. They're going to come back and they're going to sweep it. So that's exactly what we did. 1, 2, 3, 4 times we came and we swept it. In this case, price was so strong, like there was so much money in this gap that we weren't actually able to break above it. So this goes to show that liquidity is very, very strong, especially on the bigger the fair value gap is. Now, of course, that's not the only fair value gap you're going to find. We have one over here between 1, 2, 3, wick. We have a gap, 1, 2, 3, 4. And 5 if you want to count this as a rejection. Now, institutions use this to actually drive price into these areas. Why? Because there is so much liquidity in the area, markets always tend to push towards them. So in this case, we didn't have just a straight push down. We actually rejected off a fair value gap to then go higher, grab more money on the table, to then have the push lower. So guys, fair value gaps can be used as entry points because you can see, all right, well, if price comes into this fair value gap, we're going to take a long. You would have made money. At the same time, you can also say, okay, well, I'm taking a short over here. Where am I going to put my TP? Well, let's see to the left. Do we have any fair value gaps? Fair value gap. Okay, we have one over here. This can be first TP. And we have another fair value gap over here. This can be our last TP. And what happens? Perfectly respect to then have a rejection higher. So price always pushes to try to catch liquidity. So those are very key zones in the market. But you can't just take any fair value gap. You want to take a powerful fair value gap that's actually going to work. So the higher time frame you go, the more confidence that fair value gap holds. For example, we're on the 1 minute time frame over here. This fair value gap actually had a full body close. So this is invalidated. This is not a fair value gap. Look at this one over here. Full body close past it. What does that mean? Now this is actually an inversion fair value gap. We'll leave that for another video. But now this is not a valid fair value gap. So once again, mark that out. Right over here. Got broken. Not a valid fair value gap. Right over here. Not a valid fair value gap. You know the deal. I'm not going to continue repeating. But got invalidated and had that push lower. So higher time frame you go, the more valid the fair value gaps actually get and the more respected they get. For example, right here, we respected it. Guys, fair value gaps are so very important, and they are very good for having a very strong idea of where price is going to go and using them as entry points. So the best times to actually take fair value gap entries, you have 3 major times to actually consider them, and that is during macro times. That starts from 850 to 910, from 1050 to 1010, and from 1050 to 1110. I might have botched that. I'm not even sure. It's always 10 minutes before the hour and 10 minutes after the hour. So I'll have it somewhere on the screen. So looking at macros, for example, in this case right over here, we have a little baby fair value gap right over here. We respected once, we respected twice. That is a beautiful macro time to have a rejection. Again, fair value gap during a macro time. 1, 2, 3 rejections. Beautiful. Now again, this is during a macro time as well. Where I was literally just looking at it, was I not? Oh yeah, right here. So over here, we ended up invalidating it, but overall, we ended up respecting it as a fair value gap. Over here, 1 rejection. And if you want to count it, you could count it, because I'm sure on the higher time frame, you might actually have a higher time fair value gap. Let me see, 3 minute, 4 minute, 5 minute, 15 minute, 1 hour. Yeah, no. But if you wanted to catch this little scalp over here, this would have been a beautiful fair value gap macro to actually take. So oftentimes, every single macro at least has 1 fair value gap that you could take. All right, so you deserved it. This is the strategy. Look for a sell side liquidity and a fair value gap on the higher time frame. So 1 hour time frame, sell side, fair value gap, that's literally what we just covered. Now jump down to a 1 minute time frame. So in this case, we were trying to look for an entry over here. There were no inversions, there was no manipulation, no actual reason to take the entry. So perfectly fine. What do we have? A little consolidation period over here. But that does not stop us. Why? Because there is a fair value gap in this area that is getting respected multiple times. So now on the 1 minute time frame, we have 1, 2, 3, 4 respected taps. What's that telling us? Most likely on a 5th tap, we should respect it. Now, sell side, it's honestly kind of dependent on where you want to put it. There's no real right place unless you want to increase your risk just a bit. But in this case, I'd probably put it down over here. And what are we going to target? Possibly these fair value gap highs, because as I said from the beginning of the video, fair value gaps are very good for TPs. So this is a nice 2 risk to reward. Let's see, we had that tap and now we have the takeoff. So guys, this is like a beautiful strategy you guys can follow. Honestly, if you did enjoy this video, leave a like, subscribe, let me know what you think. If you want one-on-one mentorship, I do have a link down below. I think it would really benefit you. And it's a free trial, so check it out. If you like it, you could stay. If not, anyways, have a beautiful rest of your day.